This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKREFT. You're listening to episode 139. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback from me and spread the microcap message. Now, we're back. I'm back from Palm Springs, and we have a full week of podcasts available for you. Just yesterday, we published the latest episode of Avoiding the Crowd with Maj Sway-Dan, where we actually continue the conversation that we had in the previous episode about Form 4s and insider buying. In this episode, we take it another step further by discussing three stocks that had some heavy insider buying last week. So go check out this episode on Apple, Spotify, or YouTube, and also on the website on Podbean at avoidingthecrowd.podbean.com. On the next episode of In the Market Trenches with Gary Reevy and Eric Fure, we actually tackle a similar war story theme covered on here before. Think of this as kind of like a Time Kills All IRRs Part 2. It's a really interesting story that you'll be able to also hear on Apple, Spotify, YouTube, or Podbean at inthemarkettrenches.podbean.com. And the Investors Roundtable is back this week. Tune in every Friday morning to watch the latest episode of the Investors Roundtable every week. You never know who might be joining our panel or what topic will be discussed. Just have to tune in every Friday to find out. To listen to every new episode of the Investors Roundtable, please subscribe to the SNN Network YouTube channel, which is youtube.com/SNNWire. And I promise audio-only version is coming soon, so stay tuned for that. Now, for this episode of the Planet MicroCap Podcast, I spoke with Jeremy Deal, portfolio manager of Jdp Capital Management. For those of you who are watching this on YouTube, my background is Amsterdam. In honor of Jeremy, he's based in Amsterdam. I thought it'd be kind of fun to take everybody on a journey to a beautiful day in Amsterdam. So I was actually originally introduced to Jeremy via Matthew Peterson. Thank you, Matthew. And since then, Jeremy has joined us on the Investors Roundtable, specifically episode number 6. And it was time to highlight Jeremy's investing philosophy and thesis. In this interview, you'll learn all about Jeremy's criteria for identifying and buying survivors and thrivers. So thank you again for tuning into episode 139 of the Planet MicroCap Podcast. And please enjoy my interview with Jeremy Deal. Back to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and I'm really excited for our guest that we have for you today. He's coming to us all the way from Amsterdam, hence Amsterdam. In fact, I think he sees this on his walk every single day. And so without further ado, I got Jeremy Deal. He is the founder and CIO of Jdp Capital. Jeremy, thank you for joining me today. How you doing?
Yeah, thank you for having me.
Yeah,
it's nice to be able to come on here one-on-one. I think the last time we did, I've watched so many of your episodes or so many of your shows, and I think the last couple of times we did this, I was part of a group, so it'd be nice to have a one-on-one chat here.
Oh, absolutely. I'm so excited for the topics that we're going to be covering today. I think it's very, very timely, that to say the least. And I wanted to make you feel more at home. Look,
I appreciate that. Yeah.
When we're on the round table, I get, we can get crazy with our backgrounds, but today I figured, I'd come to you. That's what we can do virtually now.
I'm glad you didn't put San Diego behind you, because then I'd really be missing home. So at least I'm seeing what I see every day.
Hey, as a graduate of UC San Diego, I would be I would be torturing myself too. I miss surfing blacks like none other. It's too much fun. But let's start off, man. Let's start real quick with your background and really when and where did your passion for investing begin?
So I would say that the passion for investing started at a relatively young age, maybe not as young as others, but as far back as I can remember, I was interested in business and I was interested in just economics in general. And I ended up working for an entrepreneur out of college who had sold his business to Honeywell. And I was interested in investing, but I was in San Diego and it was right after the dot-com bust. And there just wasn't a lot of opportunity that I could find that was maybe in research or with a private equity fund or a long only shop or some kind of real value oriented investment shop. The things I found were much more in sales and marketing, so in the finance world. So I went to work for this entrepreneur, and the idea was, let me learn as much about business as I can working for him and seeing business from the ground floor up, and hopefully that'll either open the door for me to start investing or just learn how to become a better investor. And it was an incredible experience. It was definitely the cornerstone and allowed me to think about business in a way that gave me the confidence longer term to start the fund. And so we were manufacturing components for home security systems. So it was electronics engineering and manufacturing business. Most of the manufacturing was outsourced, but it was a lot of engineering and design. And I did a variety of things there, but mostly worked with our international business. And so a wide variety of things from project management to sales to just about everything you can imagine, strategy. And it was a small team. And then about a year and a half after working for this group at Honeywell, he invited me to go and go with him in a startup. And so that was a little bit of a crossroads because I had planned to try to find a way to start investing. And it wasn't clear how I would go about doing that. I explored business school. It just wasn't a fit for me. And he, offered me a position to kind of help him start this, me and three other guys we had worked together to start this business. And so started a business competing with the business we worked for originally at Honeywell that he had originally sold to Honeywell. And so that was an incredible experience. We grew it really quickly and ultimately sold it to private equity. And after that exit, it was the opportunity for me to leave and start investing full time.
So Jeremy, I have to follow up real quick. I mean,
yeah,
you said while you're working on these and doing these entrepreneurial activities and going and work for these various companies, I'm assuming that you were doing some sort of research and trying to even figure out maybe what your investing strategy is, or maybe even doing some.
So I had started, I had read. So I guess let me back up. I was kind of living two lives at once. During the day, I would go to work for this entrepreneur right out of college, and then at night, I was studying everything I could get my hands on around investing. And so it was Buffett, it was The Intelligent Investor, it was learning how to read 10Ks. It was even as far as looking at private businesses that were for sale. I actually signed up with about 5 business brokers in California and just begged them to send me the prospectus on businesses that were for sale. Some of them I actually even considered trying to find a way to raise money to buy. I ended up looking at a lot of businesses, public and private, while I was still working. And so it was a rough time because I wasn't a typical kind of 20 something year old. It was all day and all night. And I had introduced myself to a couple of value managers, larger value managers, who had kind of given me that same encouragement. And one of them had told me, look, you're either born to do this or you're not. It doesn't matter if you have a CFA, it doesn't matter if you have an MBA or a PhD or whatever, either you can throw the ball or you can't. And so the best thing you can do is just, you've got 24 hours in a day, and, just maximize all those 24 hours because, I wasn't married, I didn't have any kids. And so that's what I did. I worked during the day, and then I worked at night on just being fascinated with investing. I took what ended up being hundreds of pages of notes on everything I could read. I got in touch with not just business brokers, but even later on, investment bankers, to look at much larger companies for sale, like companies with over 5 million in EBITDA. And I was just studying the pitch books, and I would have questions for them. And they knew I wasn't a potential buyer. I said, look, I'm a 20-something-year-old, and I'm super interested in everything investing, and I want to understand why this business is being auctioned off at this price versus the public company is at this price. And so I would say I was heavily involved in looking for my way, either to, and it was always a blend of public and private investing. But Buffett, and my first, I went to Berkshire Hathaway for the first time. I probably was, I don't know, in maybe my mid-20s, maybe 24 or something, 25. And, everything sort of came together for me at that first Berkshire Hathaway meeting. And I spent the time meeting with a lot of the private, the fully owned companies, or the CEOs were on the floor. At the time, you could walk the floor during the conference and meet the CEO of you name the business, was just kind of hanging out there. And so it was at the time, my questions were more so for those people around, hey, what was the multiple Buffett paid? What was the compensation? What is it really like working for him? And so it was always trying to understand and make that leap between public and private investing.
Got it. Okay. So real quick, then made the exit, and then you started Jdp Capital. What was the philosophy and strategy?
Yeah, the first iteration of JDP was actually just before just as the financial crisis started. And the idea was to do more private equity. And I thought that I could buy divisions of distressed publicly traded companies for cheap, because in the 90s, that was an interesting way to make money. You could basically cold call CFOs and biz dev people at these big public companies and say, hey, I'm a private equity fund, and try to negotiate a division for a cheap price or for even a seller note. And so some really famous private equity funds were started that way. And so I thought that, hey, this is the financial crisis. I can build a model to find really distressed public companies, especially small caps. And I know they need capital, or potentially will need capital. So why don't we try to buy some divisions or just get them for free? And so I made offers I looked at a ton of divisions and they were really, really low quality businesses. They were, the businesses themselves that were publicly traded were relatively low quality, but then the divisions they were divesting of, or because they had to divest to sell something, were just terrible. And the two things really happened that were really transformational for me. There was an aha moment where I looked up and said, wait, there's so many people bidding for these private assets, because private equity is just had an enormous amount of committed capital. People were really scared of the public markets. And so these low quality companies were being bid up to multiples that were sometimes 3 to 5x higher than the publicly traded parent was trading for. And it was an aha moment to me, like, well, do we really want to put all of our assets into some very low quality business that we're not even getting a deal on? We could just go passive and do the same amount of work and the same amount of research on the public company that's divesting this, and probably make a much higher return. And so after losing out on so many offers, I looked up and went to the investors that had pledged capital. And I said, I know this sounds crazy, but I really think we'd be better off converting this into an open-ended hedge fund structure, focusing on a handful of companies, doing the same deep research, and just going long and holding them. And I think we're going to make I think it's a more intelligent way to invest. And so there was kind of a version 2.0 of GDP that ultimately officially started in 2011.
Got it. All right. Well, this is a perfect segue to our main topic that we discussed wanting to really talk about today, which is this idea of your JDP's and your concept of investing, which is really focusing on survivors and thrivers.
Right.
And as you said, it's backed up, or we said this offline, it's backed up with endless data. So we're not going to apologize for some of the data dump you're about to hear, but trust me, it's good stuff. So,
well, and it's probably not as quantitative, so let me just start by saying, the evolution of the fund. I mean, we're 9 years old, so where it started is not where it ended. And I think I started like most deep value investors. I was, interested in companies that looked really cheap, and that changed over time. And there were, it all kind of came down to, I'd say the first couple of years, we looked at companies that, mean reversion ideas. So companies that were trading for 3 times, and we thought they were worth 5 times, whether that was revenue or earnings or EBITDA, or whatever it is. And we were at that point, with that kind of hat on, we were forced to sell that company. And so the first couple of years, returns were amazing. But what I started to notice was the ones that I would sell that were much higher in quality and had the ability to reinvest and grow were outperforming the next, third and fourth iteration of me looking for those mean reversion situations. And I started really thinking about what is it about Buffett and value investing that I think is the most powerful. What are the most powerful lessons that Buffett and Graham have taught us after doing all this work and being super interested in value investing? And I think the first one was to look at a stock. And the first 2 came from Benjamin Graham, which was look at a stock like you're buying the entire business. And Buffett talks about that as kind of the most essential lesson that he learned from Benjamin Graham. And the second thing that he learned from Benjamin Graham was, in the short term, the market is a voting machine, but in the long term, it's a weighing machine. And the final piece came from Buffett, which was on concentration, which he said something along the lines of, diversification is great for preserving wealth, but concentration builds wealth. And I thought, if you put those 3 together, what I'm doing, which was trying to look for cheap companies and sell them, has nothing to do with the way that these successful investors, or at least Buffett or other successful investors that I was interested in, had really done it. And it was also trading, constantly looking for new ideas, wasn't really a fit for my background and my personality. I wanted the opportunity to be able to dig in deep, know why I own a company for a long period of time. And so we made that transition to looking at companies that we could own for a long period of time, even if they were fully valued, even once they had become fully valued. We started thinking about, there was a lot of fear that the market, it's always been fear that the market's always valued. So going back to 2011, people were fearing the double dip of the recession, and then the European financial crisis hit, and then in 2000, there's always been an enormous fear of a correction. And when you own a company that looks statistically cheap, it seems obvious that you'd be able to go back to your investors and say, look how cheap it is, guys. Just don't worry about it. It's cheap, it's cheap, it's cheap, it's cheap. But we know that if we apply those kind of Buffett-esque rules, that's probably not the kind of business that he would want to own. And second of all, you need to know why you own the business and have a real margin of safety and why you have, the foundation for why you have a multi-year view in order to continue to own it after it's seemingly fully valued. So that led us to start studying and looking at data behind companies that had really outperformed the market over very long periods of time. And so one of the things the most important metric that we started, so what I think one of the screens that we started running that we thought was interesting was to look at companies from peak to peak. So looking at the whole data set of companies that, assuming that you would bottom at the absolute peak of a major cycle and held them until the next peak. So you're completely ignoring this kind of tragedy that happens between a peak and a trough. And you looked at the companies that between these many peaks, going back as far as we go, I think we went back to the 1940s, so we didn't have enough data to go back even further. But with the data we could find, it was very obvious that there were certain types of companies that, regardless of if you paid if you bought them at the absolute peak of the market and you held them throughout the next peak, that they were able to outperform in a big way. And these companies seemingly had nothing in common, or seemingly have nothing in common when you look at them, because they're maybe from different industries, they're different sizes, they have kind of different characteristics on at the high level. But when you dig down deep, we found 4 key characteristics that they had. And a lot of this goes back and ties back into looking at, companies that can just stay in business a really long time and have a moat that's protected. But the four components that we found were a business model that is adaptable and relevant in tomorrow's economy. So we found the companies that could survive and thrive the longest had a business model that was adaptable and relevant in tomorrow's economy. So they weren't just stamping out the same piece of metal for 20 years. They actually were able to evolve. The second piece was they had durable pricing power that was protected by a growing competitive advantage. And they had a capital allocation strategy that supported the balance sheet and the moat. And the last piece was a really strong alignment of interest between management and minority owners. And so when you add all those up, you see, when you add all those up and you overlay that into companies that have outperformed over the longest period of times, from between major peaks to major peaks, it starts to put to perspective kind of the things that we've evolved to start to use as our own filter. We started to use and definitely use today as our filter to buy things. Now, I should say we do special situations from time to time, and we do have some companies that, or maybe a little more mean reversion or back to the old days. Every now and then there's something we just can't refuse, and it'd be a small position, so something that's got maybe 5 or 10x upside, and it's something small. But for the core business, for the core fund, for the core strategy, I guess it's focusing on companies that can survive and thrive, and looking at how past survivors and thrivers have worked out between peaks is a very, very interesting study.
Oh, it's fascinating. And it makes total sense, especially based on your first point that you're saying, because you see it nowadays where, especially if you're looking peak to peak, you may see maybe the industry leader that is introducing something completely new at their first peak. Maybe they were way overvalued, and you see it's only because they have a model or a new technology or something new that just hasn't been done before. So the market is just overvaluing it when conceiving of the potential applications. And then you look at the next peak, and it's probably, and maybe that same company, based on some of your other factors that you just said, once it hits the next peak, you're like, all right, well, this was clearly the industry leader because they actualized what tomorrow's economy is going to look like for whatever that industry is. I mean, it makes total sense.
Yeah. And each of these 4 attributes drills down into, into quantitative factors, but these are the way we summarize them. But if I had to summarize, people always ask, well, so those seem very qualitative. What quantitative things do you look for? And this is, again, not my words, but the words of a lot of several famous investors that I'm interested in, that I follow. Moat, including Buffett, moat is probably the most important thing. And so what really allows a company to survive and thrive for a very long period of time, meaning it outperforms the market over really long periods of time, regardless of if you buy it at the kind of the peak. It's the ability to protect and to protect its, whether it's its gross margins, it protects. It has a moat that allows it to protect its margins and its ability to grow. And so once that's protected, the ones that can really thrive are able to reinvest at incrementally higher rates of return every quarter or every year. And the longer that a company can do that, the longer runway it has to kind of thrive from a valuation perspective and outperform the greater market.
So then what's stopping you, let's say, in your strategy? And I'm sure this might be my patented dumb question of our interview, is what's then stopping the strategy from, how do you de-risk it? In the sense that, all right, you may see a company that's trading at its peak right now. I'm not going to name any names, but I'm sure we can say a few. Right. But that are already trading at a certain peak, but maybe 10 to 20 or even 15 years away from really see actualizing what it's being valued at today? You know, how do you stop yourself from making falling into those traps?
Yeah, I think you're absolutely right. I mean, there needs to be, you know, there's no business that's worth more than its present value of future cash flows. So that's first and foremost. So you do, this is a business, and I recognize I don't have permanent capital, and I can't necessarily top tick something and knowing that it's going to go down for the next 15 years and then somehow miraculously come back at and be a 10 bagger or 20 bagger in those last 3 years of a 20-year run or something. And that's the hard part about not having permanent capital. But I think it's the essence and the way we think about a company. It's more of a guiding principle than reality. And, the goal is with such a concentrated portfolio to just be really close to everything we own. And every day is spent trying to learn more and become smarter about those companies. And so if there's a period where, we get to a point where valuation just doesn't make sense, or we just can't see past, a 5 or 7 year, 8 year time horizon, then I consider selling. Absolutely. I mean, it's hard to go past, maybe a 5 year time horizon, or maybe a 5 or 10 year time horizon, somewhere in that range. It's really hard to do that with other people's money. It's one thing to say, we don't know what's going to happen in the next quarter or the next year, and it could be down, like stuff was down a lot in March. Well, it doesn't mean we would sell it just because it was down. No. But if we felt that the earning power of the business was permanently impaired, or we had no visibility into the way the business could look in the next 5 or 7 years, or the thesis had changed dramatically, then it's time to probably move on.
And we should also probably clarify this idea of peak to peak, because I mean, if we're talking peak to peak just from a macro perspective, even if you're looking at an individual name, that name might not actually be correlated with the peak of the market either.
Absolutely. No, that's true.
So you could be looking at that at from a macro perspective, but then seeing quality businesses that, maybe still trading, well above their 52-week lows, but not continually hitting new 52-week highs, as the market continues to go up. So there's a little bit of alpha there as well.
Absolutely. No, there's, the peak to peak the peak that people are talking about now, it's just a little more relevant, I guess, because tech seems to, is outperforming traditional businesses. People talk a lot about .com, and it wasn't but a couple of years ago that the peak people were talking about was the 2007, the October 7, 2007 peak, which was the peak before the financial crisis. So we had done a lot of work on that peak to peak, and published results of companies that had outperformed, and also the inverse of that, companies that don't meet the survivor and thriver criteria, that were cheap then and never really recovered and continued to underperform the market for really long periods of time. And it didn't matter if you bought them at the peak or not, or if you bought them at the bottom, they still just sucked. So now the focus, I guess, is a little bit more on this .com peak, and the same principles apply, and actually it's an even more dramatic story of peak to peak, depending on how you want to look at it.
Well, let's dive a little deeper in there, because that was actually one of the questions that I wanted to ask you about. And this is, I'm sure, where we're going to get the data dump. So Jeremy, key us in.
Yeah, and again, I some of this stuff, I published some of it on the website, but so I think it's important to think about. There's a big difference between calling a market, or like you said, just kind of, making a forecast about a market, or observing a market peak or a market trough, and individual businesses. So the .com period, kind of Buffett was famous for almost top ticking it when he wrote this really famous piece in Forbes. And he gave a speech, and I wrote it here, and it was, let me read it. It was on November 22nd, 1999. And the actual peak was not that long after. It was actually September 1st, 2000. And he says, "I think it is very hard to come up with a pervasive case that equities will ever over the next 17 years perform anything like, and he writes anything like again, they've performed in the past 17 years. So he was right. The NASDAQ, fell 78% from peak to trough. The S&P fell about 46%. And again, I may not have all these numbers exactly correct. I'm just using a lot of Cap IQ data. But I think what gets, and again, to his point, let's just see how if he was right, and he was absolutely right that, he was calling the next 17 years. So the prior 17 years before the SPY had been up 224% with dividends, and the NASDAQ had been up 455%. And the following 17 years, the S&P was only up 112%, including dividends, which is about half. And the NASDAQ was only up 58%. So, he was absolutely right. But I think what is really fascinating about it is if you drill down what actually was happening below the surface, so that statistic definitely does not tell the whole story. So I think that tells the whole story. If you're an index investor, or if you're a passive investor putting your money in some kind of a Schwab account, or if you have a financial planner that's just kind of putting it over a wide diversified basket of things, I think that kind of thing is really important. But if you're a long-term investor and you have what you feel is some kind of business insight on a handful of businesses that you believe will survive and thrive over a long period of time, this kind of fear about this kind of next a peak or a trough or whatever is less relevant to you. So some interesting things. So some of the trough though to today is kind of a side note. That's not a peak to peak, but as just a student of financial history, I find that some of the most fascinating numbers I've ever seen in markets are that kind of trough to today. And so as we were talking about a little bit before the show, I'll just read some interesting statistics. So the NASDAQ compounded at 14.3% annually for the next 18 years. So this is trough 2001 through today. And a third of those companies were 10 baggers or more, which is really interesting. So and the trough to peak produced 2,300 baggers and more than 50 baggers. So you had a lot of companies like Netflix was 135,000%, Booking up 25,000%, Boston Beer up 6,200%. And so these, I don't know, Decker's Outdoor, it's just the list goes on. Decker's Outdoor up 20,000%. So was the market right that just, was the market right to sell everything off? So it's, of course, there's going to be businesses that were really overvalued, and we can get into that later and what was actually going on at that time versus not. But what I think we can switch to is kind of the peak to today. So if we kind of back out and we reran that and we go back to the absolute peak of the dot-com boom, and we all went away on a desert island, and what would have happened if looking back 20 years, how bad would it actually have been? So it wasn't great, but it also wasn't as bad as I think most people think. So the S&P compounded at about 6.2% a year, 238%. And the NASDAQ compounded about 182%, or it was up about 182% or 5.3% annually. So more than about 60%. So what we did to look at peak to peak, let me back up, is we looked at companies that were continuously traded. So it's a little bit of a disadvantage because there's a lot of companies that are no longer exist or went out of business or were merged or whatever. They're not part of this study. So the company had to start with 250 million or more market cap, so it had to be investable. So we kind of ignored anything below 250 million in market cap, so ignored all the little small stuff. And we looked at things, like I said, that were continuously in business from that peak till today. So it produces only about 1,150 companies, but I think it's not going to be absolutely accurate. If we had a list of all the companies, we got to see all the failures, the outcome would look different. But I think it is interesting to start and look at the companies that, the companies that did survive at least the whole time. Did they thrive or not? And how did they look at the end? And how correct was the market? And for the companies that did thrive, what were the characteristics of those businesses? And how could you have thought about them? So some interesting statistics. So of that data set that I just explained, which again is definitely far from perfect, more than 60% of all the companies from peak to today, so peak.com to today, beat the market. Or beat the S&P 500. And the top 25% returned 3,700%. Companies like Apple were up 13,600%, Monster Beverage 77,000%, Texas Pacific Land Trust 7,700%, Moody's up 3,000, Activision up 8,000. I mean, the list goes on and on. It's actually a fascinating look to think, wow, for such a dramatic period in time where everybody really felt like they learned the tooth fairy wasn't real, to have those kind of returns, if you had just bought okay companies or companies that you thought could have continued to survive and thrive, what the outcome would have been, and just completely ignored the bottom. The inverse of this is also really interesting to think about. So many of the bottom never recovered. And the bottom, I think most people think, well, these must have just been shell tech companies or kind of, remember there was this documentary called .com or something. There was a documentary about a startup that busted, they raised a bunch of money and it went to zero. Well, many of the bottom performers, the ones that are still around that collapsed, never recovered. So the bottom never recovered. And companies like, for example, Revlon, down 90%, Rite Aid down 84%. Now this is from then to now. So these are companies that continued to survive the whole time, and probably, I don't know how they looked, if they looked cheap relative to that time period or not, but Revlon, Rite Aid down 84%, Goodyear Tire down 48%. Micron Technologies, which is a company a lot of people are familiar with today, is still down 41% from that .com peak. But again, so the story of the NASDAQ being overvalued and the market being overvalued at the time was right. But does that mean that you can't find not gems, but just can't put a little bit of work into a company or come up with a framework that allows you to think about a company and how it's going to continue to go, what's going on in the business?
I mean, it's still so hard because, I mean, even, those statistics are incredible. I mean, I definitely found myself on certain days when I'm looking at Apple or a Netflix, and going back to the chart from 2001 or 2000 and just like, just to depress myself, of course, with the hindsight bias. But, thinking about a Netflix, full disclosure, I'm not a shareholder in either, but thinking about a Netflix.
I'm not a holder of any of the companies I mentioned.
So, but like thinking about a Netflix, for instance, I mean, you think about, and you try and draw parallels to today. You think about a Netflix at the time. Like, I remember being a subscriber to Netflix and getting the DVDs I forgot how often they came, or as soon as you sent them back, right? Like, how could you have possibly thought that, okay, they're going to eventually turn this into a streaming business? I mean, that I was a user at the time, I guess I could have seen it. But then when you take the next level and think about the economics of it, well, how are we supposed to think that was eventually going to be successful, and then convert that into having all this cash to then invest in their own content? I mean, you almost have to be a futurist, let alone an oracle.
Not necessarily. I think that what this recent kind of market I don't know, volatility or what COVID has really surfaced for me, looking at peers and just generally market participants. Most people don't really know what they own. Most people traditional value matrix around balance sheet and income statements and whatnot. I mean, they're a fit for mature businesses. And that is, looking at a company's financial matrix is a very small step. And I think it's a very important step to understand how a business makes money and how they will make cash flow in the future. but it is nowhere near the end of the work that I think a business owner, investor, somebody that's following these Buffett rules, somebody that's thinking in terms of buying a stock like they're buying a whole business. And I think I would put it back on other people. I would say, people that think like that, I would say, look, if you're really a value investor and you hold those values true, that you're buying a stock like you're buying the whole business, you mean to tell me that you would just buy any business just because it was cheap? And most people, if they said yes, they don't have any experience buying and owning companies. They don't have any experience with buying and holding a company for a really, really long period of time where they don't control the cash flows and they're not being paid on distributed cash flows or IRR like a private equity fund did. Because if you let price dictate everything you do, the best case scenario is you'll have to trade a lot. That's the best case scenario. The worst case scenario is that you end up not only generating probably a high tax bill, but I'd say the typical case is you'll end up underperforming the longer you go out. And that's why you see a lot of managers, a lot of fund managers, when you get out really long, like 20 plus years, they just can't beat the market. And it's because there's an over-reliance on the past financials. And so I think the question is, maybe you couldn't have, but there are people that were deep enough into Netflix and understood what was happening in the business to make that kind of bet, because Netflix in and of itself is a fascinating story, and there's a lot of work that's been done out there. There's a lot of podcasts on the history of Netflix and Reed Hastings and how it worked and the different iterations of the business. But from a fundamental perspective, in order to own something a long time, you need to understand how the business works. And you need to have a perspective on how the business is going to be more relevant in the future than the past. So that means the company is going through enormous transitions. And so instead of focusing on what did the earnings look like this quarter, I think it's important in order to do this kind of investing. And I'll say there's people that are making money. There's people successful doing there's all kinds of styles that work, right? There's global macro guys that are successful.
Yep.
There's short funds that are super successful. There's day traders that are successful. There's all kinds of stuff. But to be a concentrated investor in companies with a 5+ year time horizon does require a lot of work on understanding what's happening in the business and what's happening in the sector. And it's a full-time job, and it's not as simple as just screening for past numbers and extrapolating them into the future linearly, right, especially.
Well, no, I think the main thesis here, and it goes back to, a number of investors have come on here and said similar things, but I think you're really driving this point home, is that, look, at the end of the day, you can do all the work you want on past financials and doing your valuation and seeing if it, is it cheap, not cheap, fairly valued, what have you. But if you truly know the business very well and you have that, I'd argue even 3 to 5 or longer year time horizon, you could probably get a good idea of what future trends are coming and how that business you own might take advantage of that or evolve in order to capitalize on that. Am I kind of hitting on that's what you think?
Yeah,
about?
Absolutely. And I think today what's happening is where people are misunderstanding and I think where people get it wrong and I've been guilty of getting it wrong, is misunderstanding where the battleground, so to speak, is, where the fight is actually happening. So you look at two businesses and you may think that it's all about, for example, just selling advertising, but in fact it's something different. And so where the battle is being fought is evolving all the time. It's never as simple as I stamp a widget out, I invest in a widget, I stamp it out, I sell it, because those business models are constantly changing. The way we buy things, the way we interpret things, the way business is done, the digitalization of the enterprise, all of this is changing so rapidly that you need to have a view on that. And so just sitting back and just assuming that everything just mean reverts back to the way it is or was is, I think, a recipe for maybe not failure, but it's a recipe to underperform.
I mean, not to bring up a name that you own, but I mean, you've talked about it previously on other roundtables. We were talking about your investment in Spotify.
Yeah.
Just looking at that as an example. Full disclosure, I'm not a shareholder, but just looking at that as an example. I mean, I was a subscriber to Spotify just for having access to all this music, and now you're seeing the huge pivot into podcasting. Every one of my shows is now uploaded on there, and they're allocating a lot of capital to develop original shows and buying Gimlet, buying The Ringer. I mean, that's a perfect example.
Spotify's been an investment of JDP for I don't know, maybe just shortly after it went public, and the stock was flat for a long time. It went public in a way that just allowed people to just start bidding on it. So they didn't do a typical underwriting process, which I also admire. The founders didn't sell any stock into that, and they didn't use the IPO to raise any money because they've been self-funding for a really long time. But Spotify, like all of our core investments, have the luxury of reinvesting 100% of their gross margin back into the business and incrementally higher rates of return than they did the year before or the quarter before. And we're attracted to Spotify because we're seeing that not only is the user base growing, but globally, and they're in such a leadership position over the competition. But it's not just that. We felt like we're seeing that the users are spending, subscribers are spending more and more time on the app than the competition. So I believe today the average Spotify user spending 25 hours a month on the app, and that's continuing to grow as they add more services and add more value, like podcasts. So, Spotify is absolutely an example of a company undergoing a major transition. The way they started in the original business model is simply music streaming and sharing that revenue and paying the big labels for the music for a license is not at all the way Spotify is evolving to or is looking. Yes, they'll continue to pay for music, but the value, you want to own the company that controls, as Ben Thompson says, controls the demand, not the supply. So you want to own the company that controls and determines who is listening to what, because that is ultimately the person that can extract the most value. And we call it kind of the railroad of audio. And so I think people will be surprised of the number of businesses and opportunities that they can build on top of that user base as time goes on to increase pricing power. And because at this point, you're just adding so much value to your life that it's just harder and harder to say no. So I don't need to go on and on about a pitch on Spotify, but
no, of course, and that was.
But I do think it's an absolute. So we do see it as a survivor and thriver, and it's one that we're not concerned about. At any given point, whether the stock is at 100. I mean, I think we paid 113 or 115 a share or something. Whether it's now 280 or whatever it is, we're looking out over the next 5 years, and we see a company that is only scratching the surface at what is possible in audio. And we also see a company that just has really no competition, even though it feels like I can stream this music on Apple, I can stream this music on Amazon. But those are secondary, auxiliary businesses that are just streaming catalogs. They're not focused on kind of owning what we call the audio railway. And I think people are going to be surprised about the opportunity it's already unlocking for not only margin expansion, but just growth and the flywheel that's starting there. So it's a survivor and thriver, and one that we want to own, whether the price is 280 or whether the price is 50. We're really excited about what's happening in that business.
Very good. Well, you already used that as an example. So, I mean, the main thing that I think people probably listening to this want to know then, in our current market right now, I mean, How do you go about then identifying companies like a Spotify right now?
So it's really hard. We only have a handful of portfolio companies. And
it's just really
you're
hard.
constantly questioning yourself. I always question myself. And every day I get up, every day I start reading, I read something new. Do we have a process where we cycle through the holdings and focus on different parts of the business or different parts of a sector? I don't think you can be in this business and not constantly second guess yourself. It's hard to ignore Mr. Market. It's hard to just really have your head deep in the business, in the game, and have a goal, like Gavin Baker says, of being in the 1% of knowledgeable of knowledgeable holders of the company. I would say there's nothing easy. I mean, even this year, we try to trade very, very little, but definitely there's mistakes. I mean, sometimes you buy something that you think is a survivor and thriver, and then you get deep into it, and you realize maybe it's a year later, maybe it's 6 months later, that one of those 4 key attributes is not being met, and that's happened several times. And I think you have to start with, in order to become that knowledgeable about a business, you have to focus on a specific sector that you know well, or are really passionate about, or interested in becoming an expert in, and maybe making an investment, and then letting that circle of competence grow over time. So over the last 9 years, I've covered and invested in a wide variety of things, and there's a handful of sectors that I've naturally gravitated to, that I like, that I'm interested in, that I want to study 7 days a week, whether it's for the fund or not, and I would invest in privately and for the fund or whatever. And I would just do that regardless, whether it was on vacation or whether it's at 10 a.m. on a Monday. And I think that's the best source of finding companies that you want to get that deep into, or companies that you're really interested in. Because in order to understand a company, in order to put that much time into it, you have to be passionate about it. If you're not interested in banks, or you think that's boring, there's no way you're going to ever have an advantage just by buying and holding a bank based on book value growth, or its discount or premium to book value. That's not an advantage. Time in and of itself is not an advantage. The time is only an advantage for the business owner when there's compounding value happening that's significant behind the curtain. And in order to get there, you have to be really passionate about figuring it out, and it's not easy.
Nope, I couldn't agree more with that. So, Jeremy, we're starting to round the bend here. So, my favorite question I like to ask everybody on here: what's an investing experience that you'd say impacted you the most in your career?
So it was probably one of the first survivor and thriver companies that we invested in, and learned about this idea of, when it was the aha epiphany moment of moving from, just cheap companies to companies that could reinvest at a high rate of return. Well, there's actually 2, but the first one was called Cyrus One. And it was one of the first publicly traded, I don't think there were maybe 2 before it, REITs, so real estate investment trust that owns data centers. And it was a spin out of Cincinnati Bell. And I found it looking through Ted Welchler's final 13F filing of his fund before he went to go work for Berkshire Hathaway. And he had this position in Cincinnati Bell. And I just couldn't understand why on earth he would own this seemingly melting ice cube. And I dug a little deeper and found that buried inside this company was this high growth, incredible real estate business, this data center REIT, that does outsource data center space for the Fortune 1000. And so through that experience, so the company went public in 2010. And then was it 2012. And we ended up buying it in 2013 because the stock dipped quite a bit, because the sell side had a $13 or $14 price target on it. And the world didn't understand why in the future data center real estate was going to be important, because at the time people thought, well, if it is important, it's going to be all controlled by Google and Amazon. But in fact, Google, Amazon, and Apple were outsourcing some of their data center needs to pure play real estate investors. And so they also had a big bank of real estate. And they were investing almost all of their available free cash flow into hiring sales and just really building out their business, which was very different than traditional real estate businesses that a lot of time just serve to pay dividends and pay everything out. So it was more of a growth business that had this amazing position in the sector. And it was at a time when the really big companies still owned and controlled their own data centers. And they were starting to outsource that. I mean, JP Morgan, Bank of America started doing sale leasebacks and letting third parties manage and own and enter into really long-term real estate leases. And the economics behind those leases are different than traditional real estate. And there's just a lot of growth. So looking back, we paid, I don't know, something that would be like buying it for a 30 cap or a 40 cap, something in present day terms, which just seems almost impossible. But if you look at the price we originally paid versus where it ended up going to longer term, but it screened fully valued for a long time and ultimately compounded with dividends at over 400% before we sold it. So that was probably, at the time we started looking more, another one was Live Nation and the merger with Ticketmaster. So there was a handful of investments that were kind of birthed the idea of at least me getting comfortable with looking for and putting that lens on of companies that could survive and thrive, even if we missed, or even if we would continue to own and let them compound, even if they seem fully valued at any given point.
So Jeremy, we're there. Real quick before I let you go, what's some advice that you have for new investors looking to invest in the stock market right now?
Just looking to invest in the stock market. Well, if they're that early, if they're that they don't know anything about it. I'd say, like I tell my mom, just put some percentage of your excess cash in the S&P every month forever. And that's the same thing Buffett says. And if you're just going to ultimately invest in a diversified pool of stocks, you don't need to pay anybody to do that. You don't need to pay a financial planner or a financial advisor. So if you're just getting started or you just want to have exposure and you're worried about, is this the peak or is this a trough or where are we or what inning are we in, just add every month at the end of every month. And then over a period of time, you'll probably outperform. You'll be surprised that you probably outperformed a lot of people or most investors. So that would be my advice. If you just want to own the market, so to speak, and not drill down and look at companies.
Gotcha. All right. Well, how about for those who maybe have been following the markets forever and are looking at individual stocks? What's some of your advice there?
I would say one of the best pieces of advice is what Buffett said. If you're not willing to own it for 10 years, don't even take a look at it. So, he talks about the punch card analogy, the 20 punches. I think that's one of the most important lessons, again, that Buffett preaches, that a lot of value investors have steered away from or reinterpreted over the last, 20 years or however long ago, or 30 years, however long ago he said it. But, some of these are really timeless and important, really important things to think about. If you could only make 20 investments over your lifetime, would this one stock I'm looking at make the cut? And so if you're really going to do the work and you want to invest in individual businesses, the most important thing is to think like a business owner and to think in terms of, I'm buying this stock because I'm looking at this stock like I'm buying the whole business. And if I only get 20 punches, is this one of those that I want to own? And then how will that business look in 10 or 10 plus years? And if you're not willing or able to do that, because you have to keep looking at your phone and you have to worry about Fed policy and you have to worry about gold and you have to worry about what every macro person or talking head says all the time, and it's just too much for you to bear, then you should go back to just investing in the S&P slowly every month. But if you really can find conviction in something that you want to own for 10 plus years, that would be kind of listening and reverting back to those original Buffett principles on looking at a stock like you're buying the whole business. And what does that mean if we're buying the whole business and not selling it? Because at some point it will become fully valued based on interest rates and based on its sector at the time, but you still have to own it. So if you still want to own it fully valued, because it's something that you are fascinated with and believe in, I think that's the hurdle that stock should have to achieve before it makes it into whether your personal portfolio or us as a fund.
Well, Jeremy, with that, where can my audience go and find you on Twitter and social media, as well as for more information about JDP Capital?
Yeah, so jdpcap.com, and you can sign up for our, we have monthly updates, not performance updates, but we send out something, a little newsletter called, what is it called? I don't even remember now. It's called Worth a Look. So it's an interesting curated, something curated that we've come across about one of the industries that we're following or we're invested in. So we do a little write-up, and it's maybe a video or an article that is out of the way and maybe less known, and then our 2 cents on it. So we do send that out once a month. So if you go to the website and sign up, and you also get our quarterly and our quarterly performance as well. And on Twitter, I'm just Jeremy Deal. So at Jeremy Deal. So pretty original.
Perfect. All right. Well, Jeremy, dude, thank you so much for taking the time today. And also, I appreciate you delaying 15. It's my first time back at the office in a couple of weeks, and I guess LA traffic is now back. So
back to the office.
Yeah, right. Well, real quick, again, before I let you go, do you own, other than Spotify, which you said that it's in the fund, do you own any of the stocks that you mentioned?
No, I do not. Today? No, I do not. No.
Perfect. All right. Well, now I can let you go. Go enjoy the rest of your day.
If listeners are interested in looking at any of the peak to peak, we have a breakdown of it. If they send me an email through the website, happy to send you any of the data that I mentioned here today, or any of the peak to peaks from the past that we've looked at. Just send me an email. Perfect.
All right. Well, Jeremy, now I can let you go. Go enjoy the rest of the day in Amsterdam. And I really appreciate you taking the time.
Thank you. Bye.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.